chair now recognizes the gentleman from Texas, Mr. Green.
Thank you, Mr. Chairman, and I thank the witnesses for appearing. Let me start with you, Mr. Zandi, Dr. Zandi, excuse me. We all seem to make this faux pas today, but thank
really,
you for...
you can call me anything you'd like. It doesn't really.
I'll call you a friend.
Thank you. I appreciate that.
Dr. Zandi, you have wanted to juxtapose the conforming market to the jumbo market, and each time I think you were not given the opportunity to express yourself. I did step out for a moment, and I don't know whether it occurred while I was away or not. So would you kindly now give us your explanation as to why we cannot anticipate the jumbo market to be indicative of what will happen in the conforming market?
Thank you. Yeah, I don't think the jumbo market is, as I would say, scalable. It will serve a small part of the market. It does serve a small part of the market. I mean, just for context, in a normal housing market, it's 10, 15% of the market, something like that. These are usually higher quality borrowers. In many cases, they're not 30-year fixed rate loans. They're adjustable rate mortgage loans. You know, there's Peter had in his testimony, Mr. Wallison had in his testimony, go Google 30-year fixed rate loan. You do that, you get to the Wells Fargo site, and you compare a Wells Fargo conforming loan with a jumbo loan, and the interest rates are very comparable. The thing is, you have to assume a 20% down payment. If you put into the calculator a 10% down payment, which is more typical for many Americans, it doesn't calculate because they don't offer that. So that goes to the point that this is a market that is very specialized. Now, in a world like PATH, this market will expand. The U.S. economy and financial system are very adept, and they will adjust, and we'll see the ability to provide jumbo-like loans to a bigger part of the market grow, but it will never, in my view, be able to offer up 30-year fixed-rate loans to the vast majority of American households, and I think that should be a key working assumption that we want to preserve that as part of our system.
Thank you. I think that was very important for us to have in the record. Let's move to the covered bonds for just a moment. What percentage of the covered bond market is contained within the United States? If you can, Mr. Zandi, Dr. Zandi.
I think it's marginal. There's no covered bonds, or very few covered bonds I'm aware of.
And in Europe, where we do have covered bonds, we don't have, generally speaking, 30-year fixed-rate mortgages. Is this correct?
That's correct.
Which means that you won't...
Just to be precise, France has a 30-year fixed-rate market, but there's very extensive prepayment penalties, and the Danish have 30-year fixed, but that goes to the very idiosyncratic nature of their system.
But my point that I'd like to get to is that if you don't have 30-year, you have, say, 3, 5, up to 15 maybe, that means that you don't get the asset liability mismatch that you can get when you have a mortgage that will expire in 30 years, matures in 30 years, but your covered bonds, the pool, will mature in 5 to maybe 10 years. And this creates some sort of market value risk that many investors will have a second look at. Can you just briefly comment on this, please, in terms of how this impacts the market? And I would also add this, that when this occurs, it seems to have some pressure on the market to avoid the 30-year fixed rate product because of this mismatch that can occur.
Yeah, that is correct. And that's one of the reasons why you don't see 30-year fixed rate loans in other parts of the world, including Europe. And the key to the European system, and this is a point we were discussing earlier, is that the European banks are very large. So you go to any European country, 3 or 4 banks dominate the banking system, and the banking system is where all the credit's provided. And that's because they are too big to fail, and the Europeans really don't have a problem with that. That's part of their system.
Quick response to this question, please. If we have the FDIC backing in the shadows the covered bonds, would this cause the premiums that banks will pay to go up?
Okay, so that's an interesting, good point. So there is, if we're going to incent more of the mortgage lending to come out of the banking system through, say, a covered bond market, then you are using a government guarantee. It's not the Fannie Freddie or the catastrophic guarantee, it's the FDIC.
Yes.
So it's just another form of government guarantee.
Yes. So what we've done is sort of move the chairs around.
Just moving the chairs around to
Thank
some
you.
degree, yeah.